Okay, hi, welcome back to another trading corner. Yeah, the market's, still,
Wild week.
well, yeah, exactly. A lot of headline-driven price action. But has anything fundamentally changed?
Uh, yeah, I'm not sure. I mean, crude maybe feels a bit weaker, but yeah, I mean, pretty hard to trade it and to call a direction with tariff gate
Yeah,
going on.
no, it's true. Yeah, it's kind of like you have to sleep with one eye open on your X feed at the minute, just in case anything is kind of said. But fundamentally, I mean, I can't remember if I spoke about it last week, but for crude, and we'll just start there, we have a bit of a glut in the front. Um, and it's mainly driven from TI Midland. So I think local barrels around the North Sea are clearing fairly well. Um, but where TI is also pricing the benchmark, and there are a couple of barrels who are there, it's really caused some pressure on the physical diffs. So that's what we're seeing play out right now. The question is, does this sustain into the refinery maintenance season?
I mean, I think we're probably. I mean, I would argue that that weakness is we're probably beginning to see the impact of turnarounds, which I mean they'll be picking up from Feb and refineries buy their crude a few months in advance.
Yeah.
So personally, I feel like the weakness at the moment is reflective of that, and I would have thought we'll continue to have that for at least kind of another 6 weeks or so as we get into March.
Yeah. So I guess there are two things at play here. Like, firstly, it's kind of the more forward demand on the curve. So, like, you look at Brent futures, you're pricing kind of, well, you're pricing April barrels, so it's a little bit more deferred. But in dated, where it's a bit more prompt, so this overhang has come from February cargoes. So probably a little bit too early for maintenance. But I think what it's done is it's kind of shown the potential downside that we could get if there's just one or two cargoes hanging around. But because it's sold off so much, it's also opened up now these opportunities for certain trade houses, etc., to get great entry levels into buying crude. So the only caveat is whether that despite those entry levels, there's just not enough demand from
Yeah, I mean,
refiners.
I'd I'd argue that I mean fair weakness probably I would have thought that actually does reflect kind of upcoming turnarounds. So I mean they'll be picking up from kind of January and peaking in March. Um, and if you're a refinery and crude's backgrid, why would you buy barrels and hold them? So I would have thought refineries are kind of running into their crude stocks rather than purchasing in anticipation of heading into turnarounds.
Yes, for refiners who look at their balances and look at where the current margins are exactly and look at their run rates. But I would say trade houses operate slightly differently. They operate opportunistically. So right now, as I said, these Feb cargoes have been offered down to around minus 25 cents to dated, which has put the front of dated into contango, sorry,
But how much? Like,
by about 30 cents
I mean,
on
still
the
with
front 2 weeks.
yeah, but still, I guess with interest rates where they are, and you're paying for
Yeah.
vessels and for tankers,
Again,
like
for anyone that's not leveraging, yes. But for someone that can leverage, so I guess some additional information with this is we had expiry last week, which was particularly strong. I think we averaged out around 92 cents on the March April cash spread, which is really healthy levels. And the rumours are, or maybe it is common knowledge now, that one trade house took a lot more cash than potentially they were expecting to take. So they own a lot of the cargoes for March. Right now, how we're pricing is back end Feb. So in the next 2 weeks, we'll be pricing these March barrels, which potentially is what this trade house owns a lot of. Now, he can either keep it away from the market and buy the dated, and that will allow the market to rally a bit. If all the refiners are balanced, he can just hold them and hope to make off the dated rally, or he can sell the structure and sell into the window. So he has a bit of optionality here. The moving kind of piece is how much the refiners are actually generally going to cut, and if all of their allocations have already been filled. If there's one person with one cargo still to buy for March, it's probably going to like the risk reward on the profile of where the March structure is right now is probably to be long for that reason. But that doesn't take away from the reason of why we've got to this place in the first instance, right? Like, obviously, there was just too much crude around, and the European refiners couldn't really handle it. But we've sold off from high levels. We've come off, a good 50, 60 cents. We're in a totally different environment now. And that's what I mean when I say there's an opportunity there for someone to really position here and, pick back up and dated.
From my perspective, like coming from kind of December through to like peak turnarounds in March, like we're maybe taking like 4 to 5 million barrels a day of refinery capacity offline. So in my mind, we're likely building crude stocks over those months, and we're still backward on spreads, on futures. So personally, I would have thought, you could argue that spreads actually need to be lower to kind of to compensate that people are going to have to hold these barrels, because at the moment you wouldn't buy crude and lose cash on it, holding it in tanker.
Yeah, potentially, but then again, the market is also looking at Dubai. So right now, Dubai, the current pricing spread is around kind of 260 pricing at the minute. I think there are higher expectations of where that pricing spread was going to get to be honest. These last 3 pricing days, I don't think have been, a knockout of the park by any means of the imagination. But we're still waiting for OSPs to come out. We're waiting for Indian allocations to come out. And if those are bullish, those arbs into the east are going to open like that. And you best bet that, these slightly depressed diffs that we're seeing on these March cargoes at the minute are going to pick up. So what I mean is the correlation between the east and dated should start to pick up now, which was massively distorted last month, I would say. Like, the east was outperforming the North Sea incredibly. But now everyone's just looking for outlets, right? So if we do get that bullishness in Dubai, I think it'll pick all the benchmarks up. But so in that instance, maybe the spreads don't need to sell off. But if, Reliance don't come in and take a lot of these Dubai cargoes out of these trade houses' hands, then I totally agree. I think Brent is the thing that needs to go.
Sounds like we've got a trade. Maybe I'm selling you red spreads.
Probably. But let's see. I mean, for me, I obviously love to be long anyway. But it feels like the risk reward is massively skewed at the minute. You've got the threat of Trump and this, Chinese tariff. Like, who knows? Maybe they'll resolve this issue by the end of next week. But the main thing for me is the entry points you can get on dated at the minute are very attractive.
So I probably look more at futures and a bit more deferred. And I think if they do come off more, then personally, I'd start to look to buy. But yeah, I'm kind of waiting for more of a dip. I think we'll hit peak kind of bearishness later on in Feb.
Yeah.
Or maybe March for crude.
I think generally for dated in February, we tend to price fairly well, to be honest. Like, it's a short month. There's not too much to kind of hold up. You have IP week and etc. whatever. So it tends to actually price okay. March less so. But again, dated is trading a lot more prompt than the futures, which is why we can have that dislocation. So right now we've got the opposite going on. Dated is weak and spreads are strong. So I essentially think that's going to correct.
Yeah, that could well be a trade.
Yeah, and so that's enough crude chat, I guess. But what about products? What are you
products? Well, I mean, it's been super interesting as well. I mean, just even intraday, just very headline driven.
Yeah. Maybe we start with the HOGOs, because I saw yesterday the APIs, like, a huge draw for distillates, a massive build for gasoline, right? Is that normal for this time of year?
Well, I guess it is kind of normal for this time of year. I think they're a bit if those numbers are confirmed in the stats today, then it would be bigger than normal. The way the market's pricing today is that it's kind of fading those figures a bit, so it doesn't expect that to be right. But yeah, it's a worry. I mean, the view I've been saying is kind of long gasoline versus diesel in the summer.
Yeah.
Which actually has surprisingly not got wiped out today on that. But with those stats last night, I'm surprised that it's not moved a bit more. And also on distillate, like, you've got like Russian refineries keep on getting taken out, it's
Yeah.
like it's almost as if the market has become kind of a bit blasé on headlines.
Yeah.
I think there's just probably quite a bit of fatigue in the market, and like maybe people have stopped responding to stuff. But I mean, again, that's potentially quite bullish distillate, and also the weather. Like people have kind of written off this winter, but we could well have more cold spikes, and I expect we probably do. So like, I think the front disty market is probably underpricing the risk of maybe a move up or like a tightness that people aren't expecting. So
What do you think that is? Is it positioning? Is it stop outs?
I don't know why. I don't think it's
How's
stop
it
outs.
pricing?
So the spreads are all backward, like driven by like heating oil in the US is the strongest. So it's pricing as if we're drawing, but I mean, mainly and on a historic basis, the spreads are probably quite high. But if you look at some of the prompt flies, they're quite cheap, which to me doesn't really make sense given the potential risk that, I mean, like at this level, kind of spreads are kind of a number, so they can kind of go anywhere.
Yeah.
If we do have a supply crunch, and I think the probability of a supply, I mean, I guess base case is probably it doesn't happen, but I think the probability has been increasing, and I'm not sure we're seeing that in the pricing. I'm only watching that quite carefully because like I like being short diesel further back versus long gasoline. So I'm just wary that there's risk at the front for the distillate.
And it might drag the whole curve up, I guess.
I think if distillate spikes will probably be driven by the front, so crack boxes would go up.
Yeah.
And it feels like there's kind of still reasonable appetite to sell the back on distillate. So, and also like if the back goes up, refinery margins improve, and like you get things like refiners coming in to hedge margins. So like I'm not expecting them. I think it would move up a bit, but I'm not expecting a massive move at the back. And then on the other products, I mean, fuel oils are super strong.
Yeah.
And naphtha's finally kind of had a bit of a move up. Gasoline's been all right, and some of the boxes are quite expensive, but I'm kind of cautiously watching the stats because I think there's quite a bit of length in gasoline. So like, if we do get some horrible kind of stats numbers from the US, then I mean, we could potentially get a bit of a sell-off. So kind of cautiously watching gasoline and hoping that the APIs are wrong.
Yeah. So fuel oil especially, I mean, let's talk about that a little bit more just because I guess it's a bit more relevant with the potential, Iranian sanctions that are coming out. Even, potentially the Chinese sanctions. I know actually crude moves more from the US into China rather than the other way around. But then there was also that the Canadian tariffs, and they produce a lot of heavy sour oil there. So really it feels like, fuel is kind of the one that should be the most sensitive to these tariffs or sanctions at the minute. Is that playing out? Are people thinking that way, do you think?
I mean, I think fuel oil that you've also got to look at, I mean, what's going to happen with Iran, like, and also like Russia, like exports a lot of fuel oil, so are the refineries getting damaged? And, is that going to mean a lot less fuel oil hitting the market as well? I mean, the way the front's pricing and like the summer is, I think the market thinks fuel oil is going to be very tight.
And that's US fuel, or is it all the
I'm probably looking more in the east, but that should. The US is typically a big importer of fuel oils. They've got the most complex refineries, and the domestic US crude slates normally, well, they've got a mix of grades, but normally they need coca feedstocks. They import it. So, I mean, personally, I think that's probably right. Like, as in, coking margins still look okay to me. So even with all the move up in fuel oil that we've had, there still seems to be margin for processing it. So, yeah, personally, I'm reasonably constructive kind of fuel oil going into the summer. But I mean, I think you could argue that's in the price. Like, prices are super high. So I'm not saying I'd go out and buy summer fuel oil cracks here, but I don't expect the strength to kind of dissipate anytime soon.
Yeah, interesting. So again, that should be feeding into the Brent Dubai contract as well. The only caveat is, OPEC still have this threat of increasing their production slightly to help rebalance the market. We have had kind of, the Russian markets, also Trump, etc., kind of discussing OPEC's role and how it's helping to balance prices. So maybe they won't use that bullet yet, but they have it in their back pocket. So if we do have, Iranian oil totally taken out of the market, unlikely, but if we do, it can still be displaced by OPEC's production ultimately. Now, looking at the Dubai curve, a bit of a storm in a teacup, I think, because we had over positioning, I think, in this month's Dubai contract. People got too long at too high levels, and so it's really capped where we can price out to. They're not particularly pushing the window to get high premiums. And so, and also, sorry, that's been localized. So I think I said it last time we spoke, but what we might have is that strength is localized to 1 month and it rolls up. So in contrast, we're pricing 265 on this month's spread. Next month it's like $2 discount to that. And that might be again because OPEC still have this looming production that they can increase. So if they don't come out with that, I do expect that Dubai time spread to rally as we get closer to pricing as well. So potentially, short next month's Brent Dubai contract makes a lot of sense as well. But again, the market is positioned short already. So how much? I think this week we saw a bit of covering, but it's probably great entry levels again. Let's see. But yeah, I would say for now, as you were saying, the market's getting a bit more desensitized to these headlines. And there are a lot of dislocations on the curve. I do expect after maintenance, potentially, so like in the next couple of weeks, we should see everything settle down a little bit, especially once Trump decides whether he wants to, kind of improve his relations.
And changes his mind a few times.
Yeah, it's just, the more he does it, the less, as you said, the less sensitive the market's going to become. And his power will slowly start to diminish. We're already seeing that play out a bit. But I would expect that the market starts behaving a bit more normally once we get the allocations out from India. We can see what data is going to do in the next couple of weeks. And then, we go into run cuts. So let's see. I do agree with your Brent spread view a little bit if dated doesn't pick up. But I do think dated will pick up a bit, which might mean that there's not too much downside to the Brent spread.
But then you're probably right that, data could pick up relative to the spreads.
Exactly.
There's room for that.
There is room for that. And it does feel like the market is more confident in dated than they are in time spreads at the minute.
Yeah.
Cool. Well, we'll pick up in a couple of weeks and see if we pulled that right. Take care. Thanks.